Hello, welcome to this webinar presented by Alan Gassman and Brandon Ketron. You have their email addresses, and I hope you ask them lots of questions. Welcome to Saturday, 11 a.m. I'm here with Brandon Ketron, and we have about 35 to 40 minutes of materials to share with you on the new Bernie Sanders estate and tax bill and what to do about it and what not to do about it. You have our email addresses here. We will welcome your questions. If you just put the word Sanders, S-A-N-D-E-R-S, in the RE line, we'll know to answer that. We thank Professor Jerry Hash and Lineberg Information Services for letting us use these slides, which were prepared with the assistance of Professor Hash. There was a 90-minute program. Unlike this program, it was not free, but if you are interested in it, there is the information. I think it's available on demand for replay. Now, we have a lot of tax lawyers and CPAs on this webinar, and we have a lot of people who are not tax lawyers and don't even want to know what it's like to be a tax lawyer. So I wanted to start off by explaining the estate and gift tax system to some extent, so that everybody's hopefully on the same page here. I think everyone knows that when you die as a U.S. citizen or resident, you have the privilege of paying a federal estate tax. And today, the estate tax exemption amount, the amount of assets you can die owning, is $11,700,000. And that has been going up with inflation every year. It started at $5 million several years ago. Then it was going up with inflation, and then under the Trump administration, they were able to double it, and it is scheduled to come down to 1/2 of what it would otherwise be January 21, 2026. So we'll see who's in control of the House and the Senate and the presidency in 2026, and no one has a crystal ball, of course. The estate tax rate, if you are over 11,700,000, is today at 40%, and that would go to 45% under Bernie Sanders' bill. If you are married, then when you die, you could leave assets to your spouse and not pay any federal estate tax. So what happens here on my chart is the first dying spouse, let's say that he has $16,700,000 and that he's never made a large gift before. So his entire $11,700,000 exemption is still intact. So he dies. The first $11,700,000 can go to a family trust or a bypass trust, we call it, benefits the surviving spouse, and is never subject to federal estate tax. And then it benefits the children, and it's never subject to estate tax at their level. That's called generation skipping. On the other hand, because he's got $16,700,000, he's $5 million above the limit. If that $5 million goes to his spouse or to what we call a Q-tip trust that pays all income to his spouse, then there's no tax on the first death. And that Q-tip trust is considered as owned by the surviving spouse when she dies, so it may be taxed at the time of her death. Now, on the other hand, if he dies with only $5 million of assets, only $5 million goes into the family trust, and then there's this really neat thing called portability. And the portability law says if your spouse dies and doesn't use the whole $11,700,000, then whatever's left, in my example, $6,700,000, gets added to the surviving spouse's allowance. So her allowance goes from $11,700,000 to $18,400,000. And then she can leave $18,400,000, but if she remarries and her new spouse dies before her, she goes to the new spouse's portability allowance. So it's a little bit complicated, I agree. Right now, you could make a gift of $11,700,000, no gift tax owed, but then when you die, your exemption is going to be zero or very close to zero. in today's world. How is Bernie Sanders going to change that? Well, the first thing he's going to do is 11,000,007 is going to go to 3,000,005. And if you've already gifted a couple of million, so your 11,7 is really 9,000,007, then your 11,7 is going to go down. I mean, your 9,000,007 is going to go down to 1,000,005. That would be effective January 1st, 2022. So I have an article I wrote for Estate Planning Magazine called When to Unplug Great Grandpa. And I wrote it in 2011 saying, you know, you don't really want to be in intensive care with your family making that decision as to whether to pull that plug in late December of 2011, because they're more likely to pull it. Because if you're fortunate enough to die in 2011, there'd be no tax, like Mr. Steinbrenner. Well, we're going to hit the same thing here if this bill passes. I hope the bill doesn't pass, but be careful who you have on your healthcare power of attorney if you're over the 3,000,005 limit. The next thing that Bernie Sanders' bill will do is the amount that you can gift while you're alive will be reduced to only $1 million, and it will not go up with inflation. What they're trying to prevent is having wealthy people transfer assets so that the income from the assets gets taxed to their children at lower income tax brackets. That's really easy to do now. If I have a $10 million asset that throws off $1 million a year of income, and I don't want to pay the income tax, and I want my kids to have the million a year, I just give it to trust for my children. It's taxed at their level, not mine. They get the money. That's great. I'm not going to be able to do that after this year if the Sanders bill passes. That one may go. That one may get enough support by a Democratic Congress, which is rabid to get $3 trillion from somewhere to rebuild this country. And a couple of Republicans may well join them. Republicans who have states that want these projects. So these things that he is proposing are not out of the question. Now, on the left-hand side here, I have a life insurance trust. And life insurance has always enjoyed nice loopholes in the tax law. The life insurance lobby is always the #1 donating lobby to politicians in the United States. And periodically, they will pass bills to try to limit life insurance tax advantages. And as soon as they get that bill proposed, they get a lot of campaign contributions. And it's just a wonderful thing for everyone, apparently. We think that all life insurance trusts will be grandfathered. And we also think that, or we know that an irrevocable trust that you form for your family is going to be grandfathered if it's done before the act is passed. So let me say how this works. I have named these spouses very creatively, spouse 1 and spouse 2. Spouse 1 could make a gift to Lifetime Bypass Trust, also known as a SLAT, a Spousal Limited Access Trust. Spouse 1 could give $11,700,000 to spouse 2 as trustee of this trust, and this trust can provide that it will be held for the lifetime health, education, maintenance, and support of spouse 2, and that it will never be subject to federal estate tax. And that spouse 1 will pay the income tax on behalf of the trust. So basically, spouse 1 and spouse 2 are paying the tax on behalf of the trust. The trust grows. It's never subject to estate tax. It's never subject to creditor claims. And Bernie Sanders doesn't like this trust very much because it costs the federal government a significant amount of money in estate taxes, because almost every affluent family who has been well advised has one or more of these trusts. And I was very, very thankful to see that the proposed bill grandfathers these trusts. So if I have set up a trust for the benefit of my children, it is what we call income tax defective. I have to pay the income tax on behalf of the trust's income. That's not considered to be a gift by me to the trust. The trust is out of my estate for estate tax purposes. The trust can benefit my spouse and therefore reduce our living expenses by half if things get tough. The trust could be formed in Nevada and I could be added as a beneficiary if I ever became destitute. If my wife dies or divorces me, the next spouse could be the beneficiary of the trust, and it's grandfathered if it's established and to the extent funded before enactment. And those of you who are good long-term clients who have these trusts, probably the most important two things right now to consider is, number one, dust it off and make sure it says everything you want it to say, because we can amend an irrevocable trust by going to court or doing what's called a decanting. But for this to be grandfathered after the act passes, you can't change it. Secondly, make sure that what's in that trust is what you want to have in that trust, and that what you own individually, you could swap with the assets of that trust or sell to that trust. And that's what a lot of our clients are doing this month, is we're going through their assets, figuring out what to sell to this existing trust or a new trust in exchange for a long-term, low interest rate promissory note. The only thing that the Bernie Sanders bill does to this trust that I don't like is it says that when you die, the trust is still out of your estate for estate tax purposes, but the assets of the trust do not get a new step up. They don't get a new fair market value income tax basis, so they'll have to be subject to capital gains tax when the family sells them. That's been the IRS position anyway, but some of us believe that you can get the step up, and we've been advising our clients to file tax returns receiving the step up when somebody dies. Now, here is an irrevocable trust for descendants that spouse one and spouse two can give $30,000 a year per child to reduce their estates. So, you want to give $30,000 a year per child. That's $15,000 for each spouse to the child. You want to do that, but you don't want to give it to them directly or they'll spend it. So, if you have 10 children times 30, that's a lot of exemptions. That's $300,000 a year. We have a client who has over 100 children, grandchildren, and great-grandchildren. 100 times 15,000 is $1.5 million a year that she's able to gift. And she tells her grandchildren, keep them coming, keep them coming. But the Sanders bill throws that on the ear. Gifts to trust will be limited to $30,000 per contributor. So these clients will only be able to put in $60,000 a year into this trust. And if they're having to fund a big life insurance policy in the trust, they'll have to loan the money in using what's called split dollar life insurance. So that's another thing that the Sanders bill is doing. Now, what if the Sanders bill passes and then you want to do gifting to an irrevocable trust? Can you still do it? Could you still use your $1 million exemption to gift to an irrevocable trust and have the growth of that trust be out of your estate? The answer is yes, but but you cannot pay the income tax on behalf of that trust. It has to be a separate taxable entity. And if you sell assets to that trust, you're going to have to pay income tax if there's a gain using the installment method. Right now, the sales to a defective grantor trust are tax-free because the trust is disregarded for income tax purposes. The next thing we do, as most of you know, is we put assets into family limited partnerships and LLCs. If I put $10 million into a family limited partnership, and then I gift the 99% non-voting limited partnership interest to this trust, I'm not going to consider that to be a $10 million gift. I'm going to consider that more likely to be a $7 million gift. A discount can be taken today, but maybe not after enactment, because the Sanders bill says that discounts will not apply except to certain business assets. And this is, I enjoy this one. For it to be active in a real estate business, the person who dies needs to be spending 750 hours a year as a real estate professional, the way he wrote the bill. So we're going to have all these 80 and 90-year-olds in their wheelchairs spending 750 hours a year being driven and wheelchaired around to be active with their real estate somehow. That's going to be a nice renaissance for the elderly. You know, Colonel Sanders started Kentucky Fried Chicken when he was in his 60s, driving from restaurant to restaurant, trying to get them to buy his 7 herbs and spices, and look what happened. So don't underestimate your grandmother. Sign her up for the realtor course now while there's time. So Brandon, I've just explained almost everything, and I'm sure they're sick and tired of me, and that many of the attendees know that Brandon is definitely the brains behind the operation. Do you want to take us through these again now and go ahead and add what you think is important or anything that I missed?
Sure, Alan. So the first part here that you've already mentioned is the major one of effective January 1, 2022, the estate tax exemption is going to be reduced from the current level of 11.7 million per person down to 3.5 million per person. So a drastic reduction there. And the important part to note here is while we have the 11.7 available, it is almost a use it or lose it type of exemption. You have to get above the 3.5 amount to use that excess. So if you made a $3 million gift, when it drops to 3.5, you're only going to have $500,000 left. It doesn't come off the top. It comes from the bottom. So we have to use this exemption now or we're going to lose it. So that's an important point there. Portability allowance, as Alan mentioned, if you have any leftover exemption that's not used, nothing's going to change there. So that can continue to be transferred over to the surviving spouse. Important if you have a spouse that's going to potentially die towards the end of the year, and this is going to go in effect, you'd want to have that happen in 2021 so that 11.7 million portability allowance can transfer over and not the 3.5 that would be effective on January 1 if this were to pass. Number 3, the gift tax exemption reduced down to $1 million for lifetime giving, not adjusted with inflation, so only $1 million exemption for lifetime gifts. There's a little bit of change to the tax rates. We're going to go to 45% for gifts or for estates above $3.5 million, and then it kind of graduates from there. It's a progressive system, goes to as high as 65% if you have over $1 billion in assets, so a more progressive type tax system for the estate tax. Grantor trusts, they have the ability to essentially, the grantor pays the income taxes on the trust. That's not deemed to be a further gift under current law. Well, if this passes, then grantor trusts are going to be considered as not only owned by the grantor for income tax purpose, but also for estate tax purposes. So the grantor trust will be no more. These types of arrangements will have to be to non-grantor type trusts, meaning the trust would have to pay their own income taxes. And that also prevents us from making transfers or sales to these types of trusts without triggering income tax. So this is something that's going to be a major issue for planning if this were to pass and change the way we do a lot of things. Now, existing grantor trusts, as Alan mentions, those are going to be grandfathered, so no real issue if you've already made a sell or already made a transfer to one or more of these types of trust. You can't add anything or change anything with those existing trusts once this passes, or they will lose their grandfather type status. So once this does pass, those trusts are just going to have to sit there with what they have. No swapping assets, no funding additional gifts, no making amendments. It is what it is at that point in time. Alan also mentioned that under current law, there is authority that you might receive a step up in basis for grantor trust assets, even though they're outside of your estate for estate tax purposes. The bill specifically includes a provision that you will not get a step up for these grantor trust assets if they're not included in the estate of the grantor. It's interesting that they decided to include that because it's been an ongoing argument between estate planners for a while now whether or not these assets of a grantor trust do get a step up. To me, the inclusion of this in the bill is evidence that there is authority that they should get a step up. So if you had a client die with a grantor trust and you didn't take a step up in basis, maybe consider going back and amending returns if you can to let that step up apply. Grantor retained annuity trusts, I don't think we've talked a lot about them, but they're also known as GRATs. And essentially what happens here is you make a transfer to a trust and the trust pays you back a certain dollar amount for a period of years, 2, 3, 4 years, actuarially calculated and equal to the value of the assets transferred. So there's no real gift, but the growth above that deemed interest rate that's paid back to the grantor can be passed estate and gift tax free to a trust for descendants. The new bill would limit the effectiveness of that by requiring a longer term, so a little bit more risk involved with the GRAT, and the remainder interest would have to be equal to at least 25% of the value of the contributed property. So you'd have to make a gift transfer if you were funding a GRAT if this were to pass. Another thing here, every 50 years, a trust is essentially just going to be deemed terminated and distributed out subject to estate taxes. So there's no ongoing dynasty type trust that can last in perpetuity without paying estate taxes. There's this deemed termination every 50 years, which would trigger the payment of estate taxes. Alan, I think you're muted there.
Oh, sorry. So that, let me just point out, that doesn't mean that the trust has to end, but it does mean that the trust may be taxed as if it was in an estate. It's going to be a complicated provision, and it's kind of similar to what Canada has. Canada imposes a capital gains tax on trust assets every 21 years, as if all of those trust assets were sold. So this one will be very interesting from an intellectual standpoint, and it will be interesting in 50 years when Brandon is still practicing law to see what becomes of it. Go ahead.
Yep, it definitely will be interesting, and I'm sure things will be completely different 50 years from now at the pace we're going. It seems to be changing constantly every day. But moving on with other proposals under Sanders' bill is number 10. Alan briefly mentioned the annual gifting limitation for transfers to a trust, transfers of interest in family entities, a transfer for an asset that has a prohibition on a sale, or anything that cannot be immediately liquidated. So I guess anything other than marketable securities or cash, the annual gift exclusion is going to be limited to $30,000 in total per donor. So if you have if you have more than one kid, you're essentially limited to just a $30,000 exclusion. Or if you, under current law, if you have four or five kids, you can make $30,000 to each of those and avoid gift taxes. That's not necessarily going to be the case anymore.
So you're going to give that $30,000 cash to the child and insist that they immediately put it into an LLC you can manage or a Nevada trust that may benefit them. Mm-hmm. And then there's going to be the step transaction doctrine, but it will be interesting. And I'm sure there's a lot of life insurance lobbyists already working to try to loosen this one up.
Mm-hmm. Yeah, because a lot of life insurance premiums under life insurance trusts are paid using these annual gift tax exclusion and crummy withdrawal powers, where the contribution will be made to a trust of $30,000. The beneficiary would have the right to withdraw for a period of time. They don't withdraw because the grantor tells them not to, or I'm not going to make any future contributions. And that way it gets avoiding gift tax, and the life insurance premiums can be paid. That's going to be difficult if this passes. So we'll see what happens with this, and as the bill gets debated back and forth. There's some increased benefits for conservation easements. You get to exclude a bigger portion of those for estate tax purposes, as well as farm property. The valuation adjustment, I think, is $1 million under current law. Then it's going to go up to 3.5 under the Bernie Sanders proposal, so you get to exclude farm property. And then there's also going to be the ability to request payment deferrals for business assets to avoid having to potentially liquidate those to pay estate taxes, which can be very important given the low exclusion rate now.
Yeah, advisors need to remember to tell clients, if you have an active business, then you get a 14-year payment plan. Interest only the first 4 years at a very low rate, and then amortized over another 10. If you're in the rental industry, you don't want all triple net leases. In fact, you want to provide active janitorial and maintenance so that you are active, so you can get a payment plan under section 6166. Now, we have our Lineberg news article from last Monday. It's very similar to the Forbes article. A lot of you found out about this looking at the Forbes article. Now, if you're going to set up a spousal limited access trust, please review pages 26 and 27, or if you already have one, please review these pages with your advisor, especially with the lawyer who's going to draft it, to make sure that you take into account, okay, what happens if we get divorced? What happens if the spouse dies and I have a new spouse that I need to support? Is there a way to put this in Nevada or South Dakota or another jurisdiction where I might be able to be a beneficiary if things don't go well? What special provisions do you need to have in this trust so that I don't have to pay the income tax on the income of the trust after I don't want to? There is a way to set this trust up, fund it, and then within 9 months, dismantle it as if it never happened, using a disclaimer arrangement or using what we call a lifetime Q-tip arrangement that your tax lawyer should understand if you would like to make this basically be a conditional gift. If the transfer I make to this trust for my spouse turns out to be worth a lot more than I tell the IRS, can I use my spouse's 11,700,000 exemption by splitting the gift? Well, the way you draft this trust will have a big impact on whether you would have that cushion. Can I set up a trust for my spouse and my spouse will set up a trust for me? Or is there something called the reciprocal trust doctrine that will cause the IRS to say that they're both subject to estate tax? We are not so daring as to do reciprocal trusts. Some tax lawyers do, and I respect them. But typically it's going to be one trust formed by me for my spouse, and then one trust formed by my spouse for our descendants.
We lost your audio, Alan.
Much to the delight of people who are tired of hearing from me. Okay, so now I'm going to go to, I think, around page 67. There's plenty of reading here for those of you who might have trouble sleeping. And right now, April 2021, I could sell something to my children or a trust for my children on a 20 or 30-year promissory note and only charge 1.98% interest. That's really low from a historical standpoint. If I could lock in $1 million, I loan Brandon $1 million, 1.98% interest for 30 years. If he can invest that at 6% interest, 6% or 7% rate of return, look at the amazing estate tax avoidance that occurs there. Up to a 9-year note, only 0.89% a year. So here, a 73-year-old client, and here an irrevocable trust for his descendants, a short-term note bearing interest at only 1.2%, 0.12%, a 9-year note at 0.89%, a over 9-year note, 1.98%, or a note that cancels on death. If the client is not in good health, I can lock in a 12-year interest-only 6.2% note. And if the client dies before age 85, 0 estate tax. And we've had many families achieve this. So, it takes a little bit of the sadness out of losing great-grandpa. Or for $1 million, exchange for $86,000 a year for life. And as long as the client has a life expectancy of exceeding approximately 1.5 years, you can do this. And the right to be repaid goes away on death. So you give this trust $10 million, the trust owes you $860,000 a year. You die at the end of the 3rd year, you've only gotten about $2.7 million back. You've saved tax on the rest of it. And then there's the grantor retained annuity trust. So all these things we can do today, but we may not be able to do many of them later. Let me just show you some numbers, because don't just automatically assume that you should make an $11 million gift and that's it. Here you have a married couple with a $4 million home and $48 million investments and a conservative growth rate here you see. And they also have income. They save an average of $300 a year from their earned income. The husband will die in 6 years and the wife will live for 15 years. If they do no estate tax planning, then they will have a $42 million tax. You know, their assets will more than double, but they'll have a $42 million tax. Now, if on the first death, the amount that passes estate tax free, which will be $6,790,000 in 5 years under present legislation approximately, then the estate tax comes down by $1.5 million to $40,752,000. Okay, so they form an irrevocable trust. They put $11 million in it, and it grows at 5.5% interest, and they pay the tax on behalf of the trust. That is going to save a lot of money. That's going to bring them down to $34 million. Compare that, they were at $42 million. That trust saves $8 million at death and can be used for the spouse. So not a bad deal. If they would also loan $10 million to the trust, so the trust can have $21 million of investments and will pay them back at 1% interest, then the estate tax comes down from $34 million to $30 million. But here's the better thing. They place $32 million of investments in an LLC, and the 99% ownership interest in that LLC is not worth $32 million. An appraiser writes a report and concludes that it's worth $21,333,000. So they sell the 99% non-voting member interest to the trustee for a $21,333,000 note. So they've taken the discount that Bernie Sanders wants to do away with. They've sold the asset to a trust that will be estate tax free, and they will pay the income tax on behalf of this trust, which Bernie Sanders would do away with. This brings the estate tax way down. We were at $34 million. This brings it down to $16 million. So this is what most of our affluent clients are doing this month, or since early last year when we were doing what was called the Biden two-step. Get all the assets that may grow in value into LLCs and partnerships and sell these holding company interests to existing or new irrevocable trusts in exchange for notes. Because if Bernie Sanders is telling us that he would grandfather these, then I would hope that any legislation that comes through will allow for grandfathering. So here's spouse 1 and spouse 2, limited liability company owning significant assets. Spouse 2 funds a trust for spouse 1 and descendants. Spouse 1 funds a trust for descendants. And then they could gift assets and then sell the LLC interests in exchange for promissory notes, as you see here on page 82. The note that you get is not worth the face amount. That's another loophole that you can use with these notes. I could give you a 25-year 1.89% interest note and not consider that to be a gift, even though when the client dies, we can discount the note significantly. There's nothing that Bernie Sanders' bill does to end that. So there's a whole lot we could go over here. We promised that we would cover this in 30 minutes. We've only broken our promise by approximately 1 minute. Brandon, is there anything that you want to add, subtract, multiply, or divide here?
Yeah, just one point. I think the important point is the Sanders bill does do away with the discounts. And as you mentioned, we can put assets in an LLC and sell those at a discount today. And there's no issue with that. That's all going to be grandfathered. But to do that, we have to have those assets in there for a good amount of time before we can make the sell. You can't just come knocking on our door December 20th and say, I need to make this planning happens before the estate tax bill, passes. We can't put assets in the LLC and immediately turn around and sell them the next day or the next week. That's going to be a step transaction, and those discounts are probably going to be taken away under current law. To do this, it's best if you have them in there for at least a month or longer. So get this type of stuff set up today. So that way, if we do see that this bill is going to pass, we can go ahead and make the transfers and have the LLCs funded and ready to roll and all the documents ready to go. So we're not rushing at the end of the year to make this happen.
When you talk to your advisor, also talk about what part of the transaction needs to be disclosed on a gift tax return and what part doesn't. We prefer these sales where you put some money in the gift trust, file a gift tax return, report the money, less chance of audit. But if you report the sale, there's a greater chance of audit, but then the 3-year statute of limitations may run. So these are all things that just need to be discussed and thought through with your tax advisors. So you have our email addresses, and we can even give you our street address if you want to send us a present. Please feel free to share this PowerPoint and the video that you'll be receiving. I think within a couple of hours, you're going to be getting an email which will provide you with the PowerPoint and the video. As things change further, we'll have more webinars, and we thank you sincerely for attending this, for supporting our practice, and I hope you have a great Easter weekend.
Alan, one note before we sign off. I'm seeing a lot of questions about step up in basis for assets not in trust. And the bill as of right now doesn't do anything to step up in basis. That's still staying the same. There can be a step up for assets held outside the trust. The only thing that is changing is it's specifically disallowing the step up of assets under a grant or trust. Not other assets. Step up isn't going anywhere as of right now.
Well, there is a separate bill proposed by a very, very bright senator, I don't recall his name, that would do away with the step up in basis. And he basically is adopting the Canadian system to indicate that when you die, you're treated as if all your assets were sold and you would pay a capital gains tax. And I'm sure there's going to be that it won't apply, say, to the first $3 million of assets. They're only trying to go after the bigger taxpayers. But time will tell. When people ask us, what do you think is going to happen? What do you think is going to happen? My answer is, when I guess, I'm always wrong. I don't think much is going to happen. I think they'll close a couple of these loopholes. I don't know which ones. I'm afraid they'll close the grant or trust loophole because it's my favorite one, and I'm afraid they'll close the discount loophole because it's my second favorite one. But only time will tell. Brandon, I had such a good closing, and then you
Sorry.
brought it back. So
yeah, well, we had
that
same question from about 6 people, so I figured we might as well address it.
All right. Well, thank you very much for attending this talk, and I hope we didn't make your head spin. Thanks.